Non-current liabilities. Essentially, in this reading, we are talking about non-current liabilities. So we are on the right side of the balance sheet. Within non-current liabilities, we will look at some of the most common non-current or long-term liabilities, and those include bonds payable. Sometimes bonds payable are also referred to as notes payable. Payables that have a maturity of less than 5 years, in some countries less than 10 years. Bonds tend to be longer term, but the accounting and analysis is essentially the same. So in this reading, the term bonds payable is used. Then we'll talk about leases, the different kinds of leases. Within leases, we can have operating leases, which are considered off balance sheet, and finance leases, which need to be shown on the balance sheet. Then a very brief segment on pensions and other post-employment benefits. This particular topic is covered in a lot of detail at level 2. At level 1, we will just scratch the surface. And then finally, evaluating solvency. This essentially is some of the ratios that allow us to evaluate the solvency of a company. You have seen these ratios before, but as has happened in almost every reading, the last part of the reading deals with the relevant ratios associated with that particular topic. Okay, first, let's just understand the basic concept behind a bond and then a bond payable. Bonds are contractual promises made by a company to pay cash in the future to its lenders or bondholders. So the term lender and bondholder will be used interchangeably. Sometimes we also call them investors. So investors, lenders, bondholders all generally mean the same thing. In exchange for receiving cash in the present. Terms of the bond contract are contained in a document called an indenture. Now here is a graphic that will explain the concept. You have this company over here which needs to raise funds. Companies can raise funds through equity markets or through bond markets. When a company issues a bond, essentially it is borrowing money. So what the company does is it issues a bond. A bond is essentially a contract. It's a piece of paper. It's a promise. So the bond is issued, and this person represents an investor or a set of investors. When this investor essentially buys the bond and gives money to the company, he needs to do an analysis. He needs to say, how much money will I give to the company? And the way it works is as follows. With the bond, the company is making a certain promise that in the future I will pay you this much. I'll give you a very simple example here, and then on the next few slides we'll make it a little more complicated. Let's say that this bond right now is a bond where the company is making a promise that at the end of 1 year, the company will pay the investor $110. Okay, so the investor knows this. Now, the question is, how much money should the investor pay the company at time 0 when the bond is being issued? To come up with that amount, the investor needs to think about how much risk is he taking by investing in this bond. And then he needs to come up with the return that he requires. Given the risk that he is taking, there is a certain return that he requires. What is that return? This topic was covered briefly in quantitative methods in the reading on time value of money, and it will be covered in a lot more detail when we do fixed income later. Right now, we'll say that the investor just comes up with the 10% number, that based on the risks involved, he requires a return of 10%. So if the investor is getting 110 after 1 year, and he requires a return of 10%, how much will he pay the company today? He will pay the company 100. So essentially, if he pays the company 100 today, and he is getting 110 after 1 year, then effectively the interest rate is 10%. So this 10% is called the effective interest rate. It is also called the market rate of interest at issuance, at the issuance of the bond. So you remember these two terms, they are very important. In this particular reading, we are focused on how the company shows the bond on its financial statements at issuance and then over the life of the bond. When we do fixed income securities later, then we will take the perspective of the investor. Okay, now let's get into a little more detail. On the previous slide, I gave you a very simple example where the company said that it will pay 110 after 1 year. Most bonds are a little more complicated than that, and as you'll see later, there are a whole range of bonds with different terms and conditions. What we are going to look at in this reading is a very simple straight bond where the following information is given. A company issues a bond which has a certain face value. The face value is also called the par value. Let's say that in this particular case, that number is 100. And this information is all written on that contract, the bond contract. So the face value or par value, which are synonymous, equals 100. Issue date is 1 January 2011. Maturity date is 3 years later. So the maturity for this bond is 3 years. The coupon rate is 10% paid annually. Through this information, the company is promising a certain cash flow. Now, what is that cash flow? This is just the way bonds work. The bond has a 3-year maturity, 0, 1, 2, 3. The cash flow at the end of year 1 is 10. Where does this 10 come from? You take the 10% coupon rate, multiply that 10% by the par value, and you come up with the coupon payment. This is the first payment the company will make to the investor. Then 10 again, this is the second coupon payment, and then 10 at the end of year 3, which is the third coupon payment, and then the face value or par value of 100 is paid at the end or at the maturity of the bond. Now, the bond contract has several other details about the issuer's obligations. We will talk about this later. Now, what has been defined over here? What has been defined is the cash flow that the company will give, or the money that the company will give to the investor. The question now is, how much will the investor pay for this bond? If the investor's required rate of return is 10%, then what do we do? Or what does the investor do? How much will he pay? What he will say is that I have a required return of 10%. Let me discount all these numbers back using a 10% rate, and whatever number I come up with, that's the number that I will pay the company. If you take out your financial calculators, and here it should be fairly obvious, but I'll make you do this anyway. You plug in n is equal to 3. The interest rate is equal to 10. That's for the 10%. In this particular case, the payment is also 10. Where is this 10 coming from? Is this the coupon rate, or is this the required rate? The 10% that you are plugging into the calculator is the required rate. It's the rate that you are requiring as an investor. So this is important. In this particular example, the coupon rate and the required rate is the same, but that is not necessarily always the case. Payment of 10, these are the coupon payments. And then you plug in future value is equal to 100. That is this number over here. And all this should be familiar from reading 5, time value of money. And you then compute the present value. The present value that you should get is 100. Minus 100 on your calculator, but essentially that is the amount that the investor will pay. Now, obviously, you can hopefully see this from the numbers. If you pay 100 now and you are getting 10, 10, 10 at the end of every year for 3 years, plus your money back, you are getting a 10% return. Okay, so in this particular case, you have paid the company 100 and then you are effectively getting a 10% return. How is the issuance reflected in the financial statements? What do you do on the balance sheet for the company now? So from a company perspective, what happens on the balance sheet? The company receives cash. So assuming here that there are no issuance costs, we'll talk about issuance costs later. The cash goes up by how much? by 100, and the bond payable also goes up by 100. So that's what's happening on the balance sheet initially. What about on the cash flow side? So whenever we ask what's happening on the cash flow, you know you are getting money, but the real question is how is that categorized? Okay, so you know money is coming in, so it doesn't take a genius to figure out that money is coming in. But what a CFA level 1 candidate needs to figure out is what's the category. So this is a cash flow from financing. You have issued a bond. The issue is shown as a financing inflow. All right. What about the income statement? Initially, nothing is put on the income statement because this is at time 0. You have issued the bond. So initially, there is no expense or revenue recognized. That we will see later. Now, notice in this particular case, when the coupon rate is equal to the effective interest rate. What's the effective interest rate? It's 10%. That is also the market interest rate when the bond is issued. When those two numbers are the same, then the money raised is equal to the par value. So then the bond is issued at face value or the bond is issued at par. All right, now let's look at another scenario where the coupon rate is less than the effective interest rate. Same bond, so this information is exactly the same as what you saw on the previous slide. When the bond is issued, investors require a return of 11%. Why? Let's say that investors now perceive the company to be more risky. If an investor perceives the company to be more risky, then the investor will require a higher return. In this case, the return required is higher than the coupon rate that the investor will get. Okay, so the first question now is, how much will the investor pay? Or the other side is, how much will the company receive when it issues the bond? So here again, the company is promising a certain cash flow, and the cash flow is the same as what we saw on the previous slide. 10, 10, 10. These are the coupon payments plus the 100 par value at maturity. So what is the present value of these numbers if we discount at 11%? Notice that we need to discount at the market rate of interest when the bond is issued. If you plug your numbers into the calculator, you should have n is equal to 3. Interest rate now is 11%. And then your payment is equal to 10. Future value is 100. And if you compute your present value, what you should get is 97.56. Again, the calculator will give a negative number, but in the reading on time value of money, we talked about the plus minus, so I won't repeat that point. So the point is that the company raises 97.56. What are the entries made on the accounting side? The cash goes up by this amount, and the bond payable also goes up by the same amount. What about on the cash flow statement? This amount is shown as a cash flow from financing. It's obviously a inflow. All right. I'll make one high-level remark before moving to the next case. When the coupon rate is less than the effective interest rate, which is the scenario over here, the coupon rate is 10%. The effective interest rate, this is the rate that investors demand when the bond is issued. That is 11%. When this happens, the bond is issued at a discount. And the way you can think of it is, if you are an investor, you are paying 97.56 over here, but you are getting 10, 10, 10 and 100 back. So clearly this shows that you are getting a return more than 10%. And why do we need to do it this way? Why not just give you a 11% return? Why don't you just pay 100 and get a 11% return? The answer is the bond defines the cash flow that the company will give you. So that bond has defined this cash flow. That is fixed in this particular case. But you demand a higher return than 10%. So to get that higher return, you just pay less. When I say pay less, less than what? Less than par value. All right, so remember this relationship. I can almost guarantee that something like this will be tested on the exam. Okay, next scenario. Now the coupon rate is greater than the effective interest rate. So the bond is the same. The cash flow again will be the same. The difference now is that investors require a 9% return. The situation here is that investors evaluate the company and the bond issue and figure out that this company is actually very good and they are willing to live with a return that's less than 10%. When this happens, then we say that the bond is a premium bond because investors are now going to pay more than par value for this particular bond. So the calculation is the same as what we've seen before. N is 3. The interest rate now will be 9%. So you plug in 9 into your calculator. The payment is 10. The future value is 100. And you compute PV, you should get. So the present value is 102.53. Again, I will skip the details. This essentially is what you receive or the company receives as cash. So the entry on the balance sheet is cash goes up by this amount, bond payable goes up by this amount, and this is cash flow from financing. And as we've seen on the previous slides, coupon rate in this particular case is 10%. If that is greater than the effective interest rate or the market rate when the bond is issued, then we say that the bond is issued at a premium. All right, what we will do on this slide now is say that, okay, the bond has been issued. Over the 3 years, how do we account for the bond? What do we show on the balance sheet? What do we show on the income statement? What do we show on the cash flow statement? It's the same bond that we are talking about. Is this the discount bond or the premium bond? You can't just look at the bond and answer that question. You also need to know that when the bond was issued, what was the market rate? If the market rate was 11%, then was this a par, premium or discount bond? It was a discount bond. So we now need to look at the interest payments, interest expense, and what is the reported bond value at the end of every period, and then how are the numbers reflected in the financial statements. I have done this exercise in Excel, which I will post on our Google group, but here are the numbers. The bond was issued on 1st January 2011. The carrying value at the start of the year was 97.56. This is the number that we just calculated. The interest expense is 10.73. Where does this come from? The interest expense is always the interest rate times the liability at the start of the period. What is the bond liability at the start of the period? The bond liability at the start of the period is 97.56. You multiply this by 11% and you will get 10.73. So that is the interest expense during the year for the company. But how much money does the company actually pay? The company is paying 10. Amortization of discount. What this means is that you compare the interest expense, which is different from the interest payment. What is the interest payment? It is the coupon payment that you need to make. The difference is 0.73. Now this 0.73 is added to 97.56 and you have a carrying amount. This is the carrying amount of what? It is the carrying amount of the bond liability. The bond liability at the end of the year is 98.29. That is carried forward to the start of 2012. Again, where is this 10.81 coming from? This is 11% of this number. The interest payment again is the same. 0.81 is the amortization of discount. So this is 10.81 minus 10. Carrying amount is this, which is carried forward. Follow the same exercise. And the carrying amount at the end is 100. Why are we doing this? As a company, after 3 years, how much does the company need to give? It needs to give that par value back. So ultimately the obligation or the liability at the end of year 3 is going to be 100. But the company has shown the value as 97.56 at the start or at the time the bond is issued. So the process that we are following here, this amortization process, is taking the bond value from 97.56 at the start of year 1 to 100 at the end of year 3, which is when the bond matures. Okay, now what's the balance sheet treatment? Essentially, the bond is recorded at 97.56 at the start of year 1, and then at the end of year 1, how much is the value on the balance sheet? The amortized cost is 98.29, and then end of year 2, the liability is this. End of year 3, the liability is 100 because that's the amount the company has to pay at the end. So that's the balance sheet treatment. What about the income statement treatment? On the income statement, you show the interest expense. Is this the same as the actual money that is paid? It is not the same. But on the income statement, you need to reflect the fact that you as a company are paying 11%. And then what about the cash flow? What is the actual cash flow happening? The actual cash flow is 10. Now where does the 10 go? If you are following US GAAP, then the interest paid is part of CFO. That is just the rule under US GAAP. What does IFRS say? IFRS says that you can either put it in CFO or CFF. Okay, so for simplicity, we'll now just go with CFO, but IFRS does give you the flexibility. All right, now here is an exercise for you to do. We now look at a bond which is issued at a premium because the market rate is 9%. We have already talked about the carrying amount, so you need to do this, and I will post the Excel file on our Google group. So the initial carrying amount is 102.53. Interest expense 9.23 is based on 9%, which is coming from here, of the initial carrying amount. Interest payment is 10. Amortization of premium 0.77, that's 10 minus this number, and then the carrying amount 101.76, that is the initial carrying amount minus 0.77. And you can do the same for the remaining years. We've already talked about the treatment on the financial statements, and I will post the Excel file on our Google group. Here is another interesting question that I will touch on here, and then you will see this in detail when we do fixed income. One sort of a bond is called a zero coupon bond, where no coupon payment is made. There, obviously, when the company issues a bond, the bond would have to be issued at a discount. So, in a sense, it is a discount bond. Why? What is the definition of a discount bond? This is where the market rate of interest, let's say the market rate of interest is 10%, is greater than the coupon rate. What's the coupon rate for a zero coupon bond? It's 0%. So you can simply treat this like a discount bond. So what would the carrying amount be? given that we have a par value of 100, when will the investor receive this 100? The investor will receive the 100 at the end of 3 years. So if the investor is requiring a return of 10%, how much will the investor pay the company at time 0? So in your calculator, you plug in n is 3, payment is 0, interest rate is 10, FV is 100, and you should get a present value of 75.13. That's how much the company gets. So this is what's shown initially on the balance sheet. Then the interest expense is 10% of 75.13. So that would be 7.5. How much is the interest payment? The interest payment is actually 0 because nothing or no payment is being made. So now the amortization of discount is the difference of the two, which is 7.5, and the carrying amount at the end would be 75.13 plus 7.5. So this value will go up. And when we keep doing this for 3 years, how much should we have at the end of 3 years? At the end, you should have 100. Now, the important point here is that you keep showing an expense on the income statement, but are there any cash flows that are happening over the life of the bond? No, you just have the initial cash flow from the company perspective where the money is received. After that, there are no cash flows. So CFO will look good because no payments are being made. Income statement will actually reflect the expense. Now again, I'll put this in the Excel file that I post on our group.